Assalamualaikum warahmatullahi wabarakatuh. We are from AC22OB3G Group 4, going to present our group project for RSP Sendermhat. I'll start with the first question, whether investment tax allowing or pioneer status is the best option for RSP Sendermhat to choose to reduce the tax liability. The company should not apply for pioneer status because it is beneficial for a company when the company projects profit during the period, has no losses, and is not capital intensive. Pioneer status is not suitable for capital intensive companies since it will have high capital allowance, and when capital allowance is high, the statutory income will be low, and as a result, the company cannot maximize the amount credited to the exempt income accounts. The company suffers losses in the first 4 years of operation and only able to make small profit in the 5th year, which made pioneer status is not the best options. Therefore, the best option for tax intensive for RSP Sendermhat to reduce the tax liability is investment tax allowance, as the company operate in capital intensive business which are not expecting to generate a large profit in the short time. This is because the company incurred qualifying expenditure after commencement of the business. ITA will be given on qualifying expenditure incurred within 5 years from the date from which the approval is to take effect. The amount claimed of ITA is restricted to 60% on the qualifying capital expenditure, 40 million, during the tax relief period. The timing of such ITA to be credited into exempt income account is influenced by 70% of statutory income. Although the income account for the first 4 years of commencement of RSP Sendermhat is nil, the unutilized ITA can be carried forward indefinitely. Once the company profitable in future from the promoted activity, the ITA will be then converted into tax exempt income by setting off 70% of statutory income.
Second question is about the commencement of business on how to minimize non-allowable expenses. First of all, it is important to note the commencement date of RSP Sendermhat. As RSP is a manufacturing company, the commencement date of the business is said to be when they embark on production of manufactured goods. This is important because any revenue expenses that were incurred prior to the commencement of business is not allowed as a deduction. Meanwhile, qualifying capital expenditure incurred prior to the commencement of business is deemed incurred on the date of commencement and will be qualified to claim for capital allowance. In this case, Rm500,000 that is expected to be incurred for staff remuneration caused by RSP prior to the commencement of manufacturing process is not deductible. Thus, it is advisable for the company to incur the cost after the commencement date to enable the cost to be deducted and reduce the adjusted income and its tax liability. Furthermore, although the business could not deduct Rm40 million that will be incurred for purchase of machineries, it can still claim capital allowance for the machineries at 20% for the initial allowance and 14% for subsequent annual allowance, assuming it is general machinery. And this will reduce the statutory business income for the company and reduce tax liability.
Hi, my name is NURUL ZAHIRAH binti Muhammad NAZARI, and I will talk about leasing. There are 4 ways to do asset acquisition, which are outright cash, term loan, hire purchase, and leasings. In regards to this question, I will only explain about acquisition through leasing only. The company is not entitled to claim the capital allowance on the leased asset as the company is not the owner of the asset. Second, the company is not entitled to claim the full leasing charges which are subjected to the passenger's vehicle that are restricted to Rm50,000 and Rm100,000 as a revenue expense if it is incurred wholly and exclusively in the production of income of the company. The question is, leasing or outright purchase of assets. For assets not qualify under ITA, for example motor vehicle, choose the best options. My explanation for this question is, if RSP Sdn Bhd purchased the asset, for example, commercial vehicle in cash, the capital allowance claim will be based on the total cost of the qualifying asset with the assumption of passenger vehicle, which is non-commercial vehicle, which are limited to RM 50,000 or RM 100,000. The corporation will be able to claim an initial allowance for the first year and an annual allowance for each year after that. This is because there is no full ownership of the asset if the company acquires it through leasing. RSP is not allowed to claim capital allowance on the leased asset. If the leasing charges are incurred in the production of the company's current income, the company is entitled to claim the whole leasing charges as revenue expenses. Moreover, RSP Sdn Bhd had a current year business loss for the 4 years following the beginning of the business. The leases charge will increase the adjusted loss, and the claimed capital allowance might be carried forward to future use. The amount of unabsorbed capital allowance may only be taken against specific company losses in future assessment years. Therefore, RSP Sdn Bhd should acquire the asset through leasing.
Assalamualaikum warahmatullahi wabarakatuh. My name is SYASYA AQILAH binti MASTOR, and I will continue with the next question, which is on the interest restriction. Under Section 33 Subsection 2 of Income Tax Act, when the taxpayer borrowed money for the purpose of producing business and invest the money for other purposes, the deductibility of the interest paid will be restricted based on the formula of investment over borrowing times with interest expense. The whole amount of interest will not be deductible if the amount of investment is equal or higher than the borrowing amount. However, if the amount of investment is lesser than the borrowing, only a portion of interest will be deductible. The interest restriction will be added back arriving at the adjusted business income. However, it can be offset against the individual investment sources. If there is an excess of interest expense, it cannot be carried forward and it will be considered as permanent loss. In this case, the interest on loan that RSP made to the financial institution is not allowable expense. This is because RSP used the loan to invest in its subsidiary, which is TSB, for the construction of 5 blocks of apartments that will be rented out to the factory workers. As the loan was used for investment purpose, the interest expense will be disallowed for tax reasons. The interest restriction will be added back in arriving at the adjusted business income. However, it can be offset under Section 4D. To offset interest expense paid to the financial institution against the interest revenue received from TSV, RSP should charge TSV a higher interest rate to the extent where the interest rate is the same as the market rate. This is to make sure that TSV can claim and deduct the interest expense at the same value as RSP's interest, hence there will be no interest restrictions. Other than that, RSP Sdn Bhd also should considering to follow some of these steps to avoid interest restrictions. Firstly, RSP should identify the investment or advances funded from existing borrowings and direct allocate the cost of borrowings to the investment or advances. RSP also should review on the financial institution that offer lower interest. This will help the company to get a cheaper financing. Next, the RSP also should encourage its subsidiaries to directly borrow from the bank rather than from the holding company. Besides that, RSP need to establish a separate bank account to hold specific loan money exclusively for the business use. This will help the company to be organized with its expenses for investment and business rather than combine them in one account. In addition, RSP can create sufficient non-business income to absorb the full amount of interest expense from the loan. The amount of non-business income should be equal to the amount of interest restrictions. RSP also should dispose the investment that is not profitable to pay off the borrowing. Lastly, RSP also can withdraw the fixed deposit to settle for the borrowing.
Next is question D, which is tax planning on disposal of fixed asset. In order to minimize the tax liability, it would be best if RSP Sdn Bhd dispose its fixed asset to its subsidiary INARA Sdn Bhd, which is a loss-making company rather than to unrelated companies. This process is also known as control transfer, where in this case, the acquirer of the asset, INARA, is a person whom the disposer of the asset RSP has control. So, if RSP dispose the fixed asset to INARA, the fixed asset would be deemed to have been transferred at the tax written down value or residual expenditure of the transferor. Thus, there will be no balancing charge or balancing allowance arising on the transferor, and the transferee is entitled to claim annual allowance based on the original acquisition price, but restricted to the residual value of the asset transferred. If RSP dispose the asset to unrelated company, it will then have to bear the balancing charge arising from high resale value, which will be added under adjusted income, leading to an increase in the company's statutory income, and thus higher tax liability will be charged. Therefore, in this case, RSP should dispose its fixed asset to INARA to avoid bearing any balancing charge that will arise due to high resale value. This will prevent their statutory business income from increasing and thus reduce their tax liability.
According to TSV Sdn Bhd, it is a Malaysian corporation with RSP owning just 60% of the shares. The firm lost 300,000 every year in the present year. RSP Sdn Bhd was unable to transfer its predicted small losses for the first 4 years of operation to TSV Sdn Bhd, while TSV Sdn Bhd was unable to relinquish its current year loss of 300,000. TSV Sdn Bhd can credit its current year loss of 300,000 against its aggregate income under Section 4A to reduce its tax liability. INARA Sdn Bhd is a Malaysian corporation that is associated with RSP Sdn Bhd. From year assessment 2019 to year assessment 2021, the corporation anticipates a current year loss of 800,000 each year. RSP Sdn Bhd owns 75% of INARA Sdn Bhd, allowing them to transfer their business losses to INARA Sdn Bhd and vice versa. INARA Sdn Bhd, on the other hand, does not fulfill another qualifying requirement, which is the claimant must have specified aggregate income in the year of assessment. As a result, only INARA Sdn Bhd may give RSP Sdn Bhd its current year loss for 800,000 in order to lower their tax liabilities. Furthermore, the current year loss can be deducted from the company's total statutory income from business. Top Sdn Bhd is a subsidiary of RSP Sdn Bhd and a Malaysian firm. The firm projected yearly revenue of 1 million with no current year losses. As RSP owns 73% of the paid share capital, it can surrender its cumulative unabsorbed business loss to Top Sdn Bhd to reduce its liabilities. Top Sdn Bhd should have set a yearly aggregate income of 1 million in order to reduce the overall tax payment by the group of firms.